During a downtrend, a Fibonacci wedge can be placed, with the first trend line running up the length of an upward retracement. Then we rotate the third point down to be horizontally in line with the first point. This forms the second trend line, which will be horizontally flat. This horizontal interval of time is determined by how long the first trend line is from the first to second point that spans from the low to the high of the upward retracement. Naturally, this structure from the beginning of the upward retracement provides potential support for a falling price. And of course, that support isn't guaranteed, especially with an ideal bearish situation like this, where sustained selling keeps pushing down price after a gap down initially breaches this area. In theory, that horizontal length of the Fibonacci wedge marks an approximate duration where support from the beginning of an upward retracement provides stronger potential to oppose falling price. After this time duration has passed, support around this area will still exist, but it will often be potentially weaker and can more easily be broken through with lower amounts of sustained selling. That being said, it's still possible to have price not contact the support area from the upward retracement during the time when it is potentially stronger. And if price does later return back down to this area, falling price can still be opposed. Ideally, when price does come back down to contact this area, it will be in a situation like this with much less bearish activity, such as low red volume and a much shallower decline of price. While it would be highly advantageous for a gradual acceleration of buyers to decisively drive price up immediately or shortly after contact with this area. The idea is that after price begins to fall following a bullish movement, there is a proportional amount of time when selling has to increase and be sustained to decisively reverse the gains of that bullish movement. Often a shift back to a seller's advantage within this duration is difficult, especially if the bullish move was a steep one like this. Because in order to drive price back down to that bullish reversal point, within a proportionally shorter time duration in most cases, selling pressure normally gets exhausted easily by the time it nears that support area. And even if selling is initially strong, such as in this case, price can still flatten as a bullish advantage will remain at this area to some degree. Often when contact is made with the support area during this duration, it is possible but less likely for an injection of increased and sustained selling volume to rapidly continue the initial drop. If there is a delay to continue the drop below this area, the market will naturally flatten and even begin to incline, because during that bearish pause, there's an opportunity for buyers to more easily drive price back up for at least a short-term bullish advantage. In this case, however, previous highs are not surpassed. And in the broader context, the time advantage for the support area has passed. So it's not a surprise to see a break lower, especially with those ideal bearish conditions we've seen before, with a gap down followed by sufficient and sustained selling. Now let's apply the Fibonacci wedge during a gap up situation. You'll notice with the additional bullish context of a gap fill, the potential for an upward reversal is naturally increased, and it's possible for this to take place with less of a drastic increase in buyers. And as you may have noticed by now, the curved levels of the Fibonacci wedge do interact with price movement to some extent, but this is often a minor characteristic to pay attention to in comparison to the main focus of the trend lines. Now, with a return back to falling price, we can observe a scenario where a gap down does take place but doesn't directly reach our support area of interest right away. And although price does resume the fall relatively quickly following the gap down, selling pressure quickly subsides and is not at exceedingly high levels. So that's why, even though it has been quite some time since the theoretically stronger duration of support has passed for this area, it's still important to pay attention to more recent developments to better understand why a bullish to neutral phase has emerged, rather than the rapid continuation of a downtrend.